Hi, this is Monty Agarwal for Uncommon Wisdom Daily. Last week, we got a look at economic growth for the first quarter, and it was less than impressive. US GDP expanded at an annualized rate of just 2.2%. The good news is, the market shrugged off the lackluster data. The bad news is that this means our already fragile economy is that much closer to stalling. Of course, the number will be revised at least twice more before we get the final picture. But even if it rises, it won't move enough to make much of a difference. The report was disappointing on two counts. One, it came in below the expectation of 2.5% growth. And two, it was much lower than the 3% growth we got in the fourth quarter of last year. Now, there are four components that make up gross domestic product, or GDP, that I'd like to examine each one more closely. First up is business investment, which was positive, but less so than in the previous quarter. After almost 2 years of replenishing their inventories, companies are slowing down, which does not bode well for future corporate spending. Plus, if you look at corporate earnings, we see that they continue to be driven not by an increase in revenues per se, but by a decrease in spending. And the hiring picture isn't very encouraging either. The March jobs report was poor, and I'm afraid another bad month could seriously derail the rally in the equity market. The second and largest component of GDP is consumer spending. Overall, real personal consumption expenditures increased 2.9% in the first quarter, but outlays rose much more than income, resulting in a sharp decline in the personal savings rate, from 4.5% down to 3.9%. This is a change from the trend toward increased savings. That shift may mean that confidence is rising, or it could mean that consumers are burned out on austerity. But the danger here is that if we continue to see weak business investment and weak employment data, consumer spending could suffer. We did see a major slowdown in government spending in the first quarter as well, down 5.6%. This means fewer government contracts for the private sector, which translates into fewer new jobs. And finally, net exports were up a bit, but essentially neutral. With a contracting Europe and slowing Asian economies, it will be difficult for US companies to increase their exports in a meaningful way going forward. Overall, this was a very troubling report for me. Many of my colleagues in the hedge fund circles are predicting a return to negative growth and another recession by the end of this year. For retail investors, it's a tricky landscape. But so far, subscribers to my rapid growth portfolio have been able to maneuver through it profitably. I'm helping them to take advantage of the recent action in the stock market by both taking profits and establishing new positions, and doing so in a way that cuts their risk dramatically. I'm Monty Agarwal for Uncommon Wisdom Daily, and thank you for watching.